Hello, friends. A very good morning, good afternoon, to good evening to all of you who are joining us today from different parts of the world for another session in the Sciative Knowledge Series. I'm Dr. Anshu Jalura. I'm founder of Sciative Solutions, and I'll be your host in today's session. Today is the 16th session in the Sciative Knowledge Series. We at Sciative invited amazing speakers in this knowledge series on pricing best practices. And along these lines, a distinguished speaker today is Ted Hartnell.
Laura, it's a great honor to have been invited to participate today. Today we're going to be talking about competing with big data, the future of e-commerce competition. We're mostly going to be talking about price optimization, but we're going to be talking about other areas of e-commerce optimization also. We have a very packed agenda today. We're going to start off by calculating willingness to pay and how that's done in an e-commerce environment. Then we're going to be looking at pricing, both single product pricing and multi-product pricing. Then we're going to switch briefly and look at product and assortment optimization. And finally, we're going to look at O2O, that is online to offline. So how we can use all this data that we generated in an e-commerce online environment and how we can apply that to our offline stores. Now, I wanted to start off by posing this question to everybody. And the question is, who was the first industry that used big data to drive revenue and profitability? Now, I know there's a lot of pricing people on the line, and you guys, I'm sure, know the answer to this. So we've got some big data folks on the line as well. And I'm not trying to give a history lesson here. I just want to make a point. But the first industry was, of course, the airline industries. Back in the 1980s and 1990s, they developed yield management and revenue management. And that is the reason why, of course, we have all this crazy pricing when we jump on an airline. Everybody pays something different. Now, why did the airlines develop yield management and revenue management? Well, back in the 1980s and 1990s, at the beginning of deregulation, everybody entered into a price war, chasing prices for every route. And what that meant was bankruptcy. All these airlines were going bankrupt. Pretty much the whole airline industry was underwater. And if they hadn't developed revenue management, then they wouldn't have survived. So what happened before, at the beginning of the deregulation, all these airlines were chasing pricing. They were matching competitors' pricings for the same routes. And yield management and revenue management came along and it allowed those airlines to be proactive and look for revenue opportunities rather than being reactive and reacting to what competitors were doing. Now, I said I didn't want to give you a lesson, a history lesson. I wanted to make this point. And the point is that e-commerce essentially is in the same position that the airline industry was. E-commerce is more or less underwater. There is a few e-commerce firms doing well. Alibaba in China is doing very, very well. eBay is doing well, but it has a niche offering. Amazon is perceived to be the big winner, but Amazon has less than 1% profit margin, and everybody else is underwater. So e-commerce needs a solution. E-commerce needs a hero. And I think big data and e-commerce optimization can develop the yield management tools and the revenue management tools that allow e-commerce companies to be proactive and look for revenue opportunities. I think that big data can, again, save the day. So I want to talk about how e-commerce companies can do that, but I wanted to go back and talk about how price optimization has been done and then contrast this with how e-commerce can do it going forward. In the past, we used a lot of transaction data. So here we are, we've got our convenience store or our supermarket. They ship or sell Tide, of course, lots of other things. And they track the transaction data. So you can see down the bottom there, I've said, you need a lot of data. You need 2 years, maybe 200 stores of transaction data to develop the kind of insights that allow you to start doing price optimization. So the way that works is you track the price and the sales of one convenience store. You keep monitoring that over time. You layer in other stores that are conveniently or similarly situated. You see what happens when there's a price rise or when there's a discount, and you put everything onto a big curve. And after 2 years, you can plot a line through that and come up with a sensitivity. So here we have a relationship for Tide between quantity and price. And of course, when you raise price, you're going to lower the quantity of Tide sold. You can also get some cross elasticity. So if the price of a competing product changes, then we know what happens with the Tide product. And we can use this sensitivity data to start doing basic price optimization. All right, but it took a lot of data. Now with e-commerce, it's a very different story. Instead of following transactions, what we do is we follow the customer. We really try and understand the customer and allow the customer to give us that data. I've written down the bottom there, the data we need now is only 30 days of data. We don't need 2 years of data. And remarkably, we don't need any price variation. So with transaction data, we needed price variation before we could do any kind of analysis. With e-commerce data, we just need to know what the customer was doing. We don't need any price variation at all within the 30 days. And this is the type of data that we want from the customer. We want to know, where did they go? What did they say? What did they compare? What product did they end up buying? How much did they pay for that product? And importantly, if there is a change in the market, if there is a competitor that discounts a product or adds a new product to the portfolio or changes the positioning, then how do consumers react? All this data combined can help give us a picture of that customer's willingness to pay. So what is willingness to pay? Again, all the pricing guys would know this, but let's just review quickly. So here we have a buyer and a seller. The buyer is considering a product. He's thinking he'd pay up to 100 RMB, $100 for this product. But he wants to keep that a secret from the seller, of course. The seller's trying to read his mind. Now, imagine how different the world would be if the seller could actually see that he was willing to pay up to $100, 100 RMB. Well, the seller, of course, will then set the price right below that threshold to try and extract as much consumer surplus as possible. So e-commerce willingness to pay is the magic number that we need to calculate. That's our starting point, and that's what we're going to do right now. Now, how do you calculate willingness to pay? Well, there are techniques. This is a very well-known technique and a very good one. It's essentially, I call it A/B testing, but the real name is conjoint analysis. And we just show the consumer multiple versions of the product, and we ask them, would you buy this version or that version, given the features that we offer and given the price? So let's look at an example very quickly. This is the type of A/B testing or conjoint analysis study you might do for cameras. You show the consumer who comes in, sits down. You show them 2 cameras, camera A and camera B. They have different prices, they have different colors, they have different features, and you simply ask them, which is the better camera? And then you'd repeat this question. You'd show the customer 2 more cameras. In this case, we're trying to eliminate red as a factor here. We're really trying to force the customer to tell us which features they really want to see and buy in a camera. So here again, we've got 2 different cameras, different lenses, different flashes, different prices. And we ask these questions over and over and over and over again. We keep showing the customer different options, different options, different options. We're trying to figure out what they are willing to pay for. The math breaks out something like this. So we have 2 customers. Usually we'd have maybe 100 or 200 customers that go through this process that we bring in and sit down. Typically quite small sample sizes, relatively speaking. Now, each customer, of course, is going to have a different willingness to pay, and they're going to have a different willingness to pay for every product that they see. But let's just look at the math. They're going to have a different willingness to pay for the lenses. The customer number one is going to have a different willingness to pay for the first lens to the second lens. They're going to value the color differently and so forth, and you add up all those part worths and you get the final value. So in this case, the customer one most values the silver camera, and their willingness to pay is $350, but they would pay $250 for the other camera. Customer number two has a generally higher willingness to pay for cameras overall, would pay more for both cameras, but would prefer the red camera and have a willingness to pay for that at $500. So you guys have seen that before. I just wanted to show you how it works in the offline world, because I want to contrast it with the online and e-commerce world. And let's talk about some advantages. The big advantage of conjoint analysis, of course, is it works. It's great science. It gives us pricing. It tells us what the customer's willingness to pay is. It breaks out the part worths. It's fantastic. But there are a long list of disadvantages. First of all, it's very expensive. There are long questionnaires. The consumers are really annoyed by this. They sit down for an hour. They have to go through this annoying process of getting asked the same question over and over again. What the customer says is usually very different to what they do in a store. So there's a big bias there that you have to take account of. And the sample sizes are relatively small, a couple of hundred people. Now with e-commerce big data, you get all of the advantages with none of the disadvantages. It seems like the perfect combination. So we don't need to have this expensive process. We don't develop any questionnaires. We don't annoy our customers with these questions. In fact, we don't ask customers anything. All we do is we watch what they do online. We don't listen to what they say. We just watch what they're doing. And of course, the sample size online is much, much bigger than the sample size you would get offline. So e-commerce gives us all the advantages without the disadvantages. We can now calculate our willingness to pay. Well, how exactly do you do that if you don't give the customer a questionnaire? Well, this is one piece of the data that we've got, the click stream. It's just part of the puzzle that we have, part of the information we have about this customer, but it really helps get to this willingness to pay question. Let me show you what happens. So the customer has come onto our site. They've looked at the blue square product. Then they've looked at the blue cone. Then they've switched. They're thinking about green. They look at the green disc and then back maybe green square. And then they, you know what, go back and decide the blue cone. That's what I wanted to buy. And they go ahead and buy it. So just step back a second and think about what that is telling us, the information that we get out of that click stream. Well, it's really a whole lot of A/B tests. Okay, very similar. We see what customers are evaluating and we see what they end up ultimately buying. So we can, right away, we know that the willingness to pay for the cone is much, much bigger than all the others. And we've got so many customers that go through the same process and go through different paths that we can actually fill in the gaps and calculate the willingness to pay for all our customers. All right, so what? What does knowing the willingness to pay for our customers, how does that help our store? Well, of course, the first thing we can do is generate a demand curve. I'll get into the theory of what demand curves actually do in a second. Most of you, again, will know how to use a demand curve. But the point I'm trying to make on this slide is that demand curves used to be found in textbooks. You can see the book here. Economic books in the classroom, it was something you studied. It was not something you used in real life. Unless, of course, you had a big budget, you hired a firm to go out and do a big conjoint study and you agonized over the results. Very, very few people would actually use the demand curve in their daily life. Well, that's now changed. With e-commerce big data, we can automate this whole process, and even the smallest e-commerce store can calculate their demand curve for, just small products that they only sell a few dozen of. So you don't need big budgets to do this anymore. Now, how do demand curves work? Very quickly, we have price and quantity. There's a relationship between price and quantity. And we know if the price is $50 and the quantity we'll sell is 34. Now that's going to be very helpful if we're trying to balance our inventory, we're trying to match demand to supply, right? If we have 34 units in stock and we want to clear our inventory, then of course we just price at 50. Or we might have a revenue target, and we figure out we can meet that revenue target if we lower our price to 40, and then we sell out our 42 units. All right. Now, this curve starts to get very interesting when we add this, the profit maximizing curve. Now, we need a bit more data, of course, to do this. We need to know what the cost is for this product, but we can now calculate the profit maximizing price. All right, so we can see here if we price at 45, we sell 30 units, 35 units, and that's the maximum profit we can make. All right, fantastic, job over, we're done. Unfortunately, it's not this simple, right? This is as far as your old conjoint analysis will take you, but we've still got a long way to go. It's not that simple. So, because think about what happens when you lower price. What's the first thing that's going to happen when you lower the price of a product you offer a discount? Well, you're probably thinking, you know, my competitors are going to figure it out. They're watching my every move. You know, then they're going to discount their products. Now I'm faced with a price war. You know, I've got this big hassle. But actually, there's something even more fundamental that's going to happen to your store. Something that you're probably aware of, but you probably rarely take into consideration. And that's cannibalization. That's same store cannibalization. So you were going to, your customers came into your store, your virtual store. They found the more expensive product. That's what they wanted. That's what they were going to pay for. But then they see the discount, and they say, "Well, you know, why would I pay for the expensive product? I'll just buy the cheap product." So cannibalization, this discounting. Essentially, what's happened is you just shot yourself in the foot. So you've really got to start thinking about not the discounting of single products, but you got to start thinking about your portfolio and what your action of one product, how it's going to affect everything else you've got. Let me give you an example of that. So here we have the demand curve for our product. In fact, I've stripped away the price quantity curve. This is just the profit curve. And that orange peak is, you know, that's what we thought the profit maximizing price should be. Okay, but if we think about what's going to happen to the store versus what happens to the product, it's a very, very different story. So I'm going to add here the store profit. And what this means, this is if I lower the price of that product, what is the impact to my store? Okay, if I lower the price of the product, what's the impact to the store? And you can see the store impact is going to be very different because we got to take into account now all of that cannibalization that we suffered from. Right? And the news here is there's two stories. So first of all, the store gains are going to be considerably less than the product gains. You might think you're going to be making all this extra money, but half of it's gone in cannibalization. Store gains, it's going to vary a lot. 50% is typical, but you know, you're going to obviously lose a lot with this cannibalization. That's the first point. But the second point is you don't need to discount as much as you thought you did. You can see here in this example, you know, we thought we needed to discount from 65 down to 42. In fact, the profit maximizing price for the store is only 47. So we don't need to discount as much. And you can see that in the curves as well. The store curve is a lot flatter than the product curve. Product curve is much more sensitive, but the store curve is not so sensitive. So now we've moved out of this realm of the old way of thinking with single product pricing and discounting and price matching and chasing our competitors. And now we're starting to look forward. We're looking proactively, and we're thinking about multi-product pricing. And so here's an example. You know, you're an e-commerce store, you sell shirts, you sell red shirts and you sell blue shirts for $100, 100 RMB. And this is your market share. So internally, 75% of your sales are the red shirt, 25% of the blue shirt. And then there's this whole other market out there. Of course, there's lots of other sellers that sell shirts as well. That's all in the gray area. And let's just look at some numbers. So here we go. The red shirts and the blue shirts, they both priced at 100. They both cost $80 to make, or 80 RMB. You're selling 750 and 250 units at 75% and 25%. You can just calculate the revenue, multiply it out, calculate the profit, multiply it out, and your total profitability is 20,000 per month. Now, we have all this willingness to pay data. Well, can we use that to subtly readjust the pricing of our products? And of course we can. So this is what our price optimization will tell us, that we need to raise the price of the red shirt, lower the price of the blue shirt. Now, we don't do this ad hoc. We can only do this with our e-commerce willingness to pay data. But we subtly change the price of both these products. Our average price remains about the same, okay? And now let's look at the numbers. So, of course, fewer people are going to be buying that red t-shirt. It's more expensive. But we've given those customers a cheaper option. So we're going to see those customers flowing over and buying the blue shirt instead. So we haven't changed our internal market share. We're still selling about 100% or 1,000 units. But look at the numbers. Our revenue has increased and our profitability has increased. So we just increased our profitability by 10%. All right, same customers, more money, and the big news here too is we haven't impacted the rest of the market. We haven't stolen customers from anybody. Our average price is about the same. Our competitors are not going to flip out with their pricing, trying to chase us because they see that we haven't really adjusted our price. The bigger the portfolio, the bigger the win, the bigger the gain. So in this example, I've got 6 units now that we sell in our subcategory. We want to maintain the average price across all, and we don't want to lose any customers, but we subtly raise and lower pricing, and we can see gains between 20 and 30%. I mean, this is a huge untapped area. We're going to see a lot of profitability generated through smart multi-product pricing in the future. All right, I want to change gears and look at one more area of pricing, that's reaction pricing. And now what we want to do is we want to react, we want to find our best response to our competitors when they change price. Now this is a difficult chart, challenging chart to understand. It's called a hurricane chart because it obviously looks like a hurricane. And each row there comprising of 2 bars. Represents one competitor. So competitor A has 1 blue bar and 1 orange bar. Competitor B has 1 blue bar, 1 orange bar, so forth, so forth, so forth down, X, Y, and Z. And we're going to walk through an example, but we can see right away that competitors A and competitor B, they're the important competitors. They're the ones we need to really worry about. Competitors X, Y, and Z are totally unimportant. We can just forget about them. So let's look at an example here. So I'm focusing on competitor A. And what this chart is telling me that if competitor A lowers price by 20%, then we forecast a loss of 10% of our sales. And what we should do, our best response, is to lower our price by 8%. Okay, so let me just repeat that. If competitor A lowers their price by 20%, then we will lose 10% of our sales, and our best response is 8%. So our best response, we shouldn't just blindly match price like the industry has historically done. We find the best response that balances the keeping our customers from switching over to our competitor, but also balances out that cannibalization that's so damaging. Very quickly, competitor B, it looks like if they lowered price, we would lose about 7 or 8% of our business, and our best response is a little less than 5%, and so on. So you get down to X, Y, Z. They lower price, we barely lose any business whatsoever, and our best response is really just to ignore them. All right. So now all that data that we're crawling, all we need to really focus on is just the top few. So next is assortment optimization. We're changing gear again. Now we're going to talk about products. We've been talking about price optimization, but there's also product optimization. There's also promotion optimization, and assortment optimization falls within the products. This is a complex chart, but I'm going to cut to the chase. There is a white paper coming out about assortment optimization that explains in detail what this chart means. But I'll give you the summary. So this was a case study that we did for Coca-Cola some years back. And Coke had 14 products on the shelf in this particular distribution channel. You can see those products numbered from 1 to 14. And their question was simple, do we have the right products on the shelf? Is there something better we can be doing? And so using the customer willingness to pay and understanding the customer's best response, if a product were to be taken off the shelf, we could rank these products by their importance. Now, this is a key thing to understand. The revenue that a product brings in does not reflect the importance of that product. Okay, so look, for example, at product number 14. This is a regular bottle of Coke, a large bottle, 250 milliliters, 2.5 liters of Coke. Now, if that product sells a lot, that's a very popular product. But if it was taken off the shelf, it wouldn't matter at all. Okay, it's Coke's least important product, at least in terms of this distribution channel. And you can see what would happen if you go from number 14 to number 13. You can see the red bars. The Coke is going to lose less than 1% of customers because their customers are just going to find a different Coke SKU. They're gonna pick the 6 by 600 mils or the 2 liter bottles or the 24 cans or some other Coke variation. They want Coke. They're not going to be leaving the store. Now, jumping ahead, I'm just going to give you the punchline here. If we took 9 products off the shelf and we're just left with the 5 remaining products on the right-hand side. This is the green area on the right-hand side. If we just had those 5 products on the shelf, we got rid of all the others, then we would still keep 85% of our customers and 95% of our revenue. So now this is another optimization. This really helps us optimize how much inventory we need to stock and how to optimize the revenue from that inventory. Okay, this is my last slide. We've talked about price optimization. We've talked about assortment product optimization. We talked about how to generate those insights through calculating willingness to pay. And finally, I want to talk about how we can use that willingness to pay data to help us offline. So we used our online data to calculate willingness to pay, and now we want to apply it back to our offline stores. Okay, now online, offline, we're selling jeans online, we're selling jeans and clothing offline, with the same brand, but of course our selection is very different in the store, and our competitive environment is very different. All right, so the products are different, the competitors are different, but here's the key thing: the willingness to pay is the same. Right, the customer's willingness to pay for the online product is the same as the offline. All right, they want that brand of jean, they want that style of jean, they want that color of jean. They have a willingness to pay for that we can calculate, and we can take that offline. Now, that is not to say that online pricing is going to be the same as offline pricing. That's totally false. But we can take the willingness to pay data and we can recalculate what our offline profit maximizing price should be. Okay, because what we're doing is we're taking out competitive options for that customer and changing the competitive set and then recalculating, well, given that new competitive environment, what is the profit maximizing price? Of course, taking in cannibalization and those other things. All right, so that's a key element. Right, this now allows our online insights to really drive our whole business, offline and online. Okay, I wanted to wrap it up. I encourage you to look at the Radar technology. I've got the website down the bottom. Radar is e-commerce optimization software that calculates everything you've seen. But now, Dr. Jalora, I think maybe there's some questions from the audience we can cover.
Definitely, I do see comments posted by our audience. And before I get to those comments, let me quickly highlight some of the key points that came in your session today.
You're asking
So
me?
you started. No, I'm just summarizing on my own.
Okay, go ahead.
So you talked about how deregulation of the airline industry changed the entire pricing landscape there, and how e-commerce pricing is so different from normal retail pricing. Because in a normal retail pricing price optimization setup, you will typically work with about 2 years of data to estimate the customer willingness to pay and price sensitivity, and that's how you will build your price demand curve. Here you would also need a history of price changes along with a whole bunch of information about competition pricing, which many companies may or may not have. However, in e-commerce setup, you can work with just 30 days of data, and instead of looking at your competition or your price changes history, you basically need to focus on how customers reaction to your product offerings has changed over a period of time due to many factors that have played. And I think that's a very strong distinction that you're making between e-commerce setup and offline setup. um, I really liked your point when you mentioned about cannibalization, where you very succinctly described that you may optimize the profitability of individual products at certain prices, but because of cannibalistic effects, the sum of parts would not be equal to the sum of the entire store, which I think is a very important point that many organizations need to understand. So if you're able to increase the demand for a particular product by decreasing its prices, that doesn't mean you're gaining new customers. What could be happening is that your demand is just getting redistributed, maybe from your more profitable products to now lesser profitable products. So although you will see some products are performing like rock stars, but the overall profitability for the store or the business as a whole might actually take a hit. And you've made an excellent point over there. You talked about hurricane chart and understanding, and that companies need to understand how sensitive their business is to different competition, degree of sensitivity, as well as what is the best price response to match up against those. And you also talked about that willingness to pay online is similar in sense to willingness to pay on the offline sense. Doesn't mean that pricing has to be same, but we need to still take the channel specific factors into consideration. But customers price sensitivity would be very similar between the online space and the offline space. Well, thank you so much, these are great points. Now, one question that I would like to ask you here is that you talked about in the hurricane chart that you have a competition, you need to and companies need to understand how sensitive their business is to competition. But in today's world, what I also see is that the competition set is kind of fluid, and the degree of sensitivity to different competition would be different in different product categories. So how should companies approach this particular scenario where their degree of their most important competition might change very fast? Also, their degree of sensitivity is different in different product categories.
Right. Okay. And they're great clarification points. So this hurricane chart, every one of your products is going to have a different hurricane chart. So yeah, of course, different categories are going to be different. Different products are going to be different. But we don't look at the competitor as a brand. We don't look at the competitor as a store. We look at our product versus all of the competitive products in the set. And they're going to be different. So our competitor, our brand or store competitor A might be the most important in this category, but we might see them all the way down the bottom of the list in a second category.
Absolutely, absolutely. Um, Now, when companies are looking at optimizing the pricing of an assortment, okay, for a group of products together, and they're deciding what should be the relative pricing of the different products in the assortment of products, do they also need to consider competition price at that stage, or they can ignore competition prices at that stage?
No, they absolutely need to consider the competition. Actually, this is a very, very, very good point, because they don't need to consider competitive reaction, right? You don't have to guess what the competitor's going to do, because you can almost, not quite, but you can almost count on the fact that the competitor is not going to really react significantly. All right, because they don't see any change in their own business. They don't see loss of customers. They don't see loss of revenue or profitability. Their business looks the same, and from their perspective, your product portfolio looks the same. If you dig a little deeper, yeah, of course, there's some variation in the products themselves, but from a subcategory level, the price that you charge for that subcategory and that balance between value and price that you're trying to hit doesn't change. But when you do this subtle up-down pricing, yeah, you've got to consider a customer's going to flow to my product, or now if I priced it so high that I'm really going to lose that customer altogether, they're going to leave the store. So you do need to consider, and the radar tool that we work with automatically considers the whole competitive environment when it does do this subtle up-down price optimization.
Great. Uh, I would like to use this example of company Jet.com, which came up about a year and a half back, and certainly made its mark in the e-commerce landscape. Certainly, they were selling in more than $1 billion in revenues in a year, and of course, they are now acquired. But they did do something different with their pricing, which I think many other e-commerce companies can learn from. And I would like to take your views on Jet.com's pricing. The particular point I want to emphasize on is Jet decided to have a personalized pricing for individual customers and offer them different pricing based upon how far the customers were located from the distribution center and how much it would cost Jet to fulfill individual customers' needs. Do you think that's a great approach? Would you recommend these types of approaches to e-commerce companies? Because for a customer, shouldn't really matter where the product is coming from, right? Why should he be charged differently?
Yeah, it's a really good question. I'd have to think about it a bit, but let's take a step back. So what you're talking about is differentiation, right? So from the customer's perspective, a customer that's nearby the distribution center or the storefront is going to get a low price, and the customer's far away is going to get a high price because of the high shipping, but might get a lower price somewhere else. So from the customer's perspective, the world has a greater range of differentiated products and pricing. And generally speaking, differentiation is a really good thing for the market. You want to give customers a really wide range of products, and you want customers to have very different, broad views on those products. You know, the way customers think about Coke, from an economic and a holistic view, you want the way customers think about Coke to be very different to the way they think about Pepsi. That means that everybody is better off. And distance is just a very fundamental aspect of differentiation. So it plays right into that. So it might be very healthy.
Great. Since you're based in China, you probably are much closer to the strategies of Alibaba. Now, Alibaba has been trying to make an impact in the Indian market, and we have a question posted uh, which is talking about this. Mrunmay would like to know any views on Alibaba's entry into Indian e-commerce ecosystem. So I don't know if you've done any studies on how Indian e-commerce system is different from China, and are the success factors in Indian market different than the success factors in the e-commerce space in China?
I've only very briefly looked at, let me bring up my slide here, because I was really interested in the Indian e-commerce landscape. Yeah, so we have Flipkart has a profit margin of minus 25%. That's an outdated number from 2015. So I don't know what the situation is now, but I know a lot of people are very concerned about the performance of Flipkart. I don't really know how it's different, but I do know a lot about Chinese e-commerce, and we do a lot of studies on Taobao, Tmall, the Alibaba platforms, and it's what I call hyper competition, borrowing the term, because you have a competitor that sells a particular type of product, and you will have literally thousands of stores, tens of thousands of stores selling exactly the same thing. So this is incredibly tough competition, and you can't do it unintelligently. You can't use, rules of thumb. You can't try and be the lowest seller on the market. Those techniques are just not going to work. You've got to look at what differentiation your store brings and your brand brings, and the way you position and describe and show your products to the customer, and the way customers find and interact with you. You've got to understand the value of that differentiation. In other words, you absolutely need these e-commerce optimization tools. Otherwise, you're not going to survive. Now, you think about it, e-commerce companies, they're not product companies. They're not retail companies. What they are math companies. They're all math companies. You have to do the optimization or you will not survive.
I really like what you've said here. E-commerce companies are math companies. They need to do the calculations and figure out the best formula which will help them survive. Well, thank you so much, Ted. It's been an amazing session. You have touched upon several key aspects relating to product pricing, assortment optimization, and online versus offline pricing. And it's been very insightful. I'm sure our audience would have enjoyed the content that you have shared with them today, and they'll take notes and go back to their workplaces and start thinking about, at least if not figuring out the exact math, at least they will start thinking about how to change the way they're approaching pricing. Thank you so much for this enlightening talk.
It's been a great pleasure. Thank you very much, Dr. Julora.
For the audience, this knowledge series is being conducted by Sciative Solutions. Sciative helps companies compete and grow profitably through its scientific price optimization solutions and services. Please keep checking sciative.com for future sessions in the series. Our next session is on January 23rd, and our speaker is Geetika Bahari, and she'll be talking about hospitality price optimization. So hope to see you again in our next sessions, and thank you so much for joining today. Bye-bye.